So good morning, students. This is Dr. Abhishek this side. We're starting with the Credit Skills for Bankers Certificate (MSME), which is through Moody's, which you're going through, and you've got your login IDs and passwords. We'll just go. I'll just videos will just help you to go through the various aspects to understand the things, the concepts easily. And if you have any doubt, you can definitely reach me anytime you want. Right, so let us start with this. Let us understand the basic uh, how it is going to be like. So we'll start with part one. Part one has three units, unit on then for these three units, then you have about 8 chapters. And so first unit is overview of bank credit, SME landscape and unique lending challenges. We'll make a video for all these lessons. So let us start with lesson one, that is Indian banking system, bank credit, and link to economic growth. The other two units are legal and regulatory framework for SME lending and types of credit facilities offered to SME borrowers. So Unit 1 has 4 chapters, the Indian banking system, bank credit and link to economic growth, overview of SME classification, regulatory guidelines, understanding MSME sectoral issues and challenges in SME financing, government initiatives and regulatory schemes to promote MSME lending priority. What is MSME? It is micro, small, medium enterprises. Now, then Unit 2, Legal and Regulatory Framework for SME Lending. It has RBI guidelines and regulations for MSME sector, types of customers and legal provisions, legal structure and documents for different types of customers, types of credit facilities offered to SME borrowers. So facilities based on classification. This is the eighth lesson. Most of this we have already covered in credit analysis and banking advances course, but we'll go through this one by one. Let us go for lesson one, which is Indian banking system, bank credit and link to economic growth. So in India or in any economy, economic development is only possible if there is adequate amount of capital accumulation. So if capital is not accumulated, then that cannot be used profitably, and then there will not be any capital creation, and thus economic development will not be possible. Now, any deficiency in capital accumulation hinders economic and GDP growth. One factor stimulating economic growth is the lending of the capital from net savers to the net borrowers. So, because what happens is there are two segments in an economy, where one is surplus segment and one is deficit segment. So, in surplus segment, the for the people who are keeping their money, who are investing in banks, like they're giving their funds to the banks. And in the other segment lies the borrowers, like the borrowers who take loans from the banks, and so they help. The banking acts as an intermediary, whereby the banks help the transfer of funds from the surplus area to the deficit area, thus leading to the proper utilization of the surplus funds available, and thus leading to the development of the economy and our country as a whole. Now, banks and lenders play an important role in this flow of capital. Banks mobilize capital in the form of deposits and provide capital to the economy in the form of credit. So this is the basic function of the banking, that it acts as an intermediary between the depositors and the borrowers. So by the end of this lesson, you should be able to explain the relationship between bank credit and economic growth, explain the nature of banking industry, describe how prudent lending is critical for the overall financial health of the bank, identify the various units within the bank based on client types and their business needs. So this is lesson one. Now, what you need to know is individual companies and other business entities deposit ideal cash into banks to earn interest income. We already know this, that there are various individuals and companies and other business entities who deposit deposit the cash, the ideal cash they have into bank, and earn the interest income. In turn, bank use these deposits to lend to individuals or businesses seeking capital in the economy. Now, banks act as financial intermediaries by enabling the flow of capital from savers to depositors, savers to borrowers. Banks offer financial assistance in the form of loan facilities to various segments of the economy, including corporations, small and medium businesses, and individuals. Banks earn interest and fee based on the credit profile of the client and the nature of the credit facilities. So, also, it is very important to know what is the major income part of the bank, how banks earn their income, how they earn the profits. So it is through the interest and fee based on the credit profile of the client and the nature of the credit facility they offer. So the difference between the cost of the fund means the source of the fund for the banks is that is the depositors. So which is the cost of the average interest rate paid to the deposit holders and saving account holders of the bank, and the interest income earned by the lending these funds, that is termed as net interest margin. So the average rate at which the bank takes the loan, gives the loan to the borrowers, subtract means minus the average rate at which the bank accepts the deposits is called as the net interest margin. A net interest margin forms the core revenue stream for the bank. Now, if we talk about Indian banking system, it consists of 21 public sector banks, including SBI and IDBI Bank, and 25 private sector banks, 43 foreign banks, 56 regional rural banks, 10 small finance banks, 4 payment banks, 1589 urban cooperative banks, and 93,550 rural cooperative banks. So just an example, like 20 in public sector banks. So it includes SBI, then we have Bank of Baroda, Punjab National Bank. Private sector banks, 25 private sector banks includes giants like HDFC Bank, ICICI Bank, Kotak Mahindra Bank. Then there are 43 foreign banks, like we have Deutsche Bank, we have Royal Bank of Scotland. Then 56 regional rural banks. Then 10 small finance banks like ESAF Bank and very small Jana Small Finance Bank, and 4 payment banks like we have Paytm Bank, we have Airtel Bank, then 1589 urban cooperative banks, and 93,550 rural cooperative banks. Now, if we have already dealt with this banking, if we talk about this, it is a service industry and it services to the customers, and the depositors deposit money, whatever surplus money they have, they deposit in the bank and give interest. A bank gives lower interest on the deposits as compared to the loan, the interest they charge on the loans. So loans, they charge interest at higher rate, and they want money. If you want money, then you can borrow it from bank. So bank's revenue is interest charged minus interest earned, which is interest rate spread, also called as interest rate spread, and also called as the net interest margin, or net interest margin, NIM. So just a small diagram, savers, they deposit in the bank gives loan to the borrowers, then borrowers repay the loan with interest payments, and savers withdraw the funds they deposited in the bank with interest payment. So if you talk about the role of the banks in the economy, they enable capital mobilization. So the ideal cash, which is lying with the savers, which is lying with the depositors, it is mobilized to the part of the economy where it can be used profitably, and thus helps in the capital mobilization and capital formation, and provide finance in the form of credit. So whosoever needs funds, and he's got he or she is like qualifies for the loan, they satisfy the criteria which is set by the banks, then they can approach the bank, and they can definitely get finance for their business needs, for their personal needs, for whatever need arises in their personal and professional life. Then help expansion of the market. So it also helps in the expansion of the market because what happens is through by providing various forms of credit in the form of working capital loans and also in the form of term loans, they help the banks help the various business houses to produce more and more, and hence helps them to expand the market of their products. So banks promote capital formation. It also helps in the investment in the new enterprises, promotion of trade and industry in the economy, development of agriculture through various agricultural credits. Banks help in the development of agriculture, then balanced development of different regions. It helps in the development of the equitable development of the different regions in our country, and influencing economic activities. So it helps in the overall development of the economic activities. It helps in the by influencing the growth of a particular sector through reduced margin or lower interest rates. They can definitely influence the growth of the economic activities in an economy. An implementation of monetary policy. So whatever monetary policy is implemented by RBI is made by RBI, that is implemented through various banks. And monetary policy is a policy which the central government makes, the central bank makes, to regulate the flow of money supply in an economy. Then monetization of the economy. So it helps in monetization of the economy. It helps in the flow of money in an economy. Then export promotion sales. So it helps in the export promotion as well, thereby leading to the inflow of very important foreign funds into our economy. So this is the role of bank in the economy. Now let us talk about the importance of prudent lending. So there are various. It is very important to lend in a prudent manner to make sure as a credit manager that wherever you are lending, to whomsoever you are lending, that the person is you get back the money from the borrower, and banks doesn't suffer any loss. So there are various various factors which would lead to the prudent lending. First is risk management. So very important. It helps you to, as a credit manager, you need to make sure that the to whomsoever you lend, he is having the capability to repay back the loan, and he has got the intention to repay back the loan. And that is why the prudent lending helps in the risk management of the bank. And so minimization of bad loans. If you're having good prudent lending, then there will not be many NPAs into your book, and thereby minimization of bad loans, and finally the losses for the bank. Safeguard of banking capital, as there is a less NPA, so banking capital would grow. There will not be much losses which bank will be suffering, and this will lead to the growth of the particular bank. Then economic cycle and NPA movement. So you need to understand this, like what is the effect of the economic cycle on the NPA movement. Like there are various institutions, various business houses who they may suffer some economic distress when the economy is not going in a proper direction. Like in the present scenario, like the economic growth is not that great. There is not proper demand in the market, and this may lead to increase in the NPA, because as the business houses won't be able to earn much, they won't be able to repay their loans, and that would lead to more of NPAs. Then safeguarding the interest of the depositors and shareholders. So also it is important to lend in a prudent manner to safeguard the interest of depositors so that their money is safe, and also shareholders so that they can earn the profit, and they can get the proper dividends, right? So this is also their capital grows in a proper manner. So this is the importance of prudent lending. Now, sources of finance. So business entities in India can be divided into organized business entities and unorganized business entities. So and unfortunately in India we have more of unorganized sector, and there are many most of the people, like there are many people who are employed by these unorganized sectors. So it is very important segment of the economy. So, and the sources of finance can be formal and can be informal. So what do you what is the meaning of formal and informal sources of finance? So formal sector includes banks and financial institutions, cooperatives, which are regulated by the central bank, RBI. And informal sector, it includes money lenders, traders, employees, friends, and relatives. So they form the informal sector, which is not regulated by any central bank, and which the they it can be it is a completely unregulated. Now, banks require collateral and proper documentation for getting a loan in case of formal sector credit, but repeated borrowings can lead to debt trap, which means like you keep on borrowing and you are never able to repay back the loan. You're borrowing to repay back the loan, and again you are falling into the trap of the new loan. So this way, it will lead to the repeated borrowings, and it will lead to the debt trap. A reasonable rate of interest is charged in case of formal sector credit, but like outer planets are called Jovian planets. These planets are large in size. Their only motive is to extract profit. So there's no reasonable interest rate charged, and they are outer planets. They don't. They're and worst possible part is like these planet and these informal credit part, it forms the larger segment in our economy. Then apart from the profit making, they also have an objective of social welfare in case of formal sector credit, but their informal sector credit, the only motive is to extract profit as much as possible. And this also is very unethical sometimes and very difficult for the economy. And in terms of credit are fair and reasonable in case of formal sector credit because it is regulated, and but in informal credit they impose very tough and sometimes even unreasonable terms of credit or borrowers. You would have come across various movies where a person borrows the money especially in villages. This happens like they will borrow money for some smaller needs from zamindars and these money lenders, and then they fall into trap and end up losing their own land and even like their houses and everything, right? So the Reserve Bank of India supervises its functioning in case of formal sector credit, and but nobody there's no supervisory eye on informal sector credit. Now, sources of finance: banks, NBFCs, other term lending institutions, and securities market are considered formal. They tend to they lend to the organized sector, and unorganized businesses often borrow in an informal way from private money lenders, chit funds, friends, and relatives. It is a challenge for formal lending institutions. It is a challenge for formal lending institutions to bring the unorganized sector, which include micro business enterprises, low income groups, and individuals, under the formal lending umbrella. The uh, contribution of this segment is important to the growth of the economy because informal sector forms a huge chunk of the economy, and basically the most important part is the contribution of informal sector towards the employment. Now, banks and other formal financial institutions have over time developed a customized bouquet of solutions to meet the specific needs of both the organized and unorganized sector segment of the economy. To mobilize capital, banks offer deposit schemes such as savings account, current accounts, and fixed deposits. Similarly, to provide capital, banks offer loan facilities such as fund-based working capital, term loans, and equipment financing, as well as non-fund based facilities like we have already studied, like the bank guarantee and letter of credit, customized to meet the needs of various entities. Now, if you talk about the types of banking, if you look into the uh, your study material, then it has four types of banking. That is retail banking. Retail banking is where you are lending to the individual customers, like a car loan. you've got the bike loan, you've got home loans. They all form part of retail banking. Then micro, small, and medium enterprises banking. So MSME banking, that is banking of where you're catering to the needs of the micro, small, and medium enterprises. Then commercial and corporate banking, this is also called as wholesale banking, where you're serving the corporate and commercial clients. Then investment banking, where you are mainly taking care of the investment of the funds, and also merchant banking, where you help your clients to raise funds from the market. So this is a form of in types of banking. Now I got this some other types of banking. I just included it here so that I can just explain you. On top of these four types of banking: retail banking, commercial banking, private banking institutions. So these are private banking institutions. Then investment banking, specialized institutions like we have IDBI, we have SIDBI, NABARD. These are specialized institutions, and central banks are like we have RBI, where which regulates the banking sector in our country. Now, what do you need to know? In your role as a banker, credit professional, you're well positioned to support both your bank and the overall economy by following the best practices listed below. First thing, you have to understand and appreciate the role bank plays as financial intermediaries. You are actually a vehicle. You can be a vehicle for the development of the economy and also the growth of your bank. Now, understand lenders' role in stimulating the economy. So, if you have prudent eyes, if you can be part of the prudent lending, then definitely it will lead to the overall growth of the economy. Now, be aware of and analyze the macroeconomic environment around inflation forecast, interest rate scenarios, GDP, and industrial growth rate trends. So you need to understand and you need to be aware of the various macroeconomic factors like inflation. Like if in case inflation is on rise, then you need to make sure that why the inflation is going on higher side, and because the inflation will be on higher side, there will be decline in the value of money in the future. So it is very important to understand the movement of inflation. Then interest rate scenarios, you need to understand the movement of interest rates. There are various uh, uh, barometers like we have CRR, SLR, where the interest rate is moving. If the central bank is increasing the interest rate, it means it is trying to suck back the enough of the liquidity which is available in the market, and so that there is no excess liquidity in the market, and this will lead to a shrinking of credit. And then GDP, if GDP is doing fine, if economy is doing fine, GDP is a measure of the growth of economy, and if GDP growth is on higher trend, then definitely industry is going to be on higher trend, and there will be better scenario for lending to good to the industries, because when the economy is doing good, then there are less chances of any particular credit into turning these particular types of credit into NPAs. So there is less chance like these loans will turn into NPA. But if economy is not doing good, then there are bigger chances. There are larger chances that these um, your loans will be turning into NPAs. So industrial growth rate trends, again, it affects your lending. So if industrial growth rate trend is on higher side, it is going to improve, then definitely you should be aggressive into your lending. But when the industrial growth rate trend is not conducive, then you should be conservative in your lending. Now, keep abreast of changes in the government policies that are linked to key sectors of the economy. So, if government policies are pro towards any sector of the economy, then it means government wants to promote that particular part of the economy, and thereby lending to that particular segment in the economy is becomes less riskier than lending to the other segments of the economy. And develop a better understanding of various segments within your bank. So it is very important to understand, to develop a very good understanding of the various segments within your bank. Then analyze the credit policies for your borrowing segment. So Every bank has its own credit policies. You have to, as a credit manager, when you join your bank, first day you have to take that credit policy and read it thoroughly, get well accustomed to the credit policies of the bank, and analyze the those credit policies for your borrowing segment. For example, if you are placed into MSME, then you should be analyzing those credit policies for MSME segment. Now, understand the prudent lending practices that have been put in place and learn how to identify the right clients within these parameters. So, this is something which you need to learn. You need to understand the various prudent lending practices, how to become a good credit manager, and also put in place and learn how to identify right clients. So it will happen over a period of time when you gain experience into credit, that you will be able to identify how to identify right kind of clients. So there are various parameters, quantitative as well as qualitative. There can be various ratios if I talk about quantitative parameters, and qualitative parameters can be the capacity, the intention of the borrower, the existence of the borrower in the same business, and that way. So this is very important. Now, how this is useful, you understanding your role in the economy, very important. You as a credit manager will be playing a very important role in the development of the economy. Understanding how credit policy and sound lending practices help mitigate the loss of capital due to bad loans. So if you have good credit policy and sound lending practices, then there will be less NPAs and less bad loans. Both depositors and investors have entrusted you with their money and expect you to safeguard it by lending only when you are sufficiently certain a loan will be repaid. Your broad understanding of the underlying connections between the macroeconomic indicators in terms of economic and policy changes and the impact on the SME sector will help you build better credit decisions. So it is very important to read one economic newspaper every day and to analyze the changes happening in the market and the impact of those changes on your segment of lending. So if you take into consideration the cautionary signals of these economic indicators, you'll be able to take proactive steps to mitigate potential bad credit as well as enhance your level of due diligence by sourcing new clients. So this is how it is. Now, what are the questions you should ask to yourself? Will an increase in the savings rate help reduce the overall cost of the credit for the borrowing segments? So if there is growth of savings in the economy, will it help the reduction in the overall cost of the credit for the borrowing segments? How does a change in the interest rate impact borrowing needs and repayment capacity? How can I use key macroeconomic trend indicators to improve my understanding of how they will impact the economy and our credit lending policy? How can I identify the key sunrise sectors? Sunrise sectors means the rising sectors segments contributing to the growth of the economy and position my bank to offer more loans. So let us deal with these questions one by one. So first question says, like, will an increase in the savings rate help reduce the overall cost of credit for the borrowing segment? Definitely it will. Why? Because if the savings increase, then there will be surplus funds available in the form of banking deposits, and that will lead to the surplus of funds in the market, thereby reduction in the interest rate for the borrowing segment, because the banks will be aggressive at lending because they will have the deposits, excess of deposits available with them. Now, how does a change in interest rate impact borrowing needs and repayment capacity? It's very simple. Like, if central bank increases the CRR, SLR, then what will happen is banks will deposit more money into with RBI, and then banks will have less of funds, and that will lead to the increase in the lending interest rates, because banks don't have funds to lend to the banks have less of funds to lend to the economy, and that's why they will increase the interest rate. So how can I use key macroeconomic trend indicators to improve my understanding of how they will impact the economy and our credit lending policy? Very important to have a basic understanding of various macroeconomic indicators, as we dealt in the last slide, like GDP, your industrial growth rate trends, interest rate scenarios, and inflation forecasts. Then it will help you to understand the growth of the economy, the particular segment of the economy which is rising, and the sector which is rising is known as sunrise sector or segment, where you can divert your funds, where you can divert your lending, and thus it will contribute to the growth of the economy and position your bank to offer more loans. So thank you. This is